Hello everyone and welcome to this review segment on commodities investing within the alternative investments topic area. Just a short, there's a few mind map slides to go through and we'll point out some key elements of commodities investing. So let's do that now. Look at all the different sectors here. Commodities split up mainly into sectors, so energy, things that we can burn basically to produce energy, so crude oil and natural gas. We got metals, both precious and base. Grains and softs, agricultural commodities there, and more agricultural, but livestock, actual live animals rather than plants and cereals that we grow. We can see over here on the right hand side that we can split out the sectors into its constituent parts a little bit. So oil and natural gas, of course, is the energy. Oil's life cycle, it is stored very briefly. Storage costs are a big part of commodities investing, of course. Oil is stored for a brief time before it's being refined, so there's that heavy degree of processing that's required. Of course, crude oil can be turned into all sorts of different types of fuel and other materials. Natural gas doesn't require much processing at all. It comes out of the ground and it's piped to where it's used and then it's burnt quite nicely. So less processing involved with gas. Grains, as you might expect, seasonal production will be stored for quite a long period of time in some cases. And metals as well, they require rather large manufacturing facilities and are storable. Livestock, certainly the life cycle of the livestock and how it's treated varies with the animal. And softs, these are the sort of cash crops, agricultural crops that are produced in warm climates. In terms of valuation of commodities, we do have some challenges. We can't use discounted cash flows because the assets don't produce cash flows at all, really, while they're, when they're being produced. The only cash flow you get is when you finally sell them. So it's quite difficult. The prices tend to be based then on just the old traditional economic laws of supply and demand. The price roughly should be the present value of the future selling price. In terms of a couple of definitions here, compare the futures price. Now, commodities futures tend to be much more liquid than the commodities themselves. So if we look at the futures price and compare it to the spot price, the actual price of the commodity, if the futures price is greater than the spot price, then the market is said to be in contango. If the futures price is less than the spot price, then it's in backwardation. The difference between the two is known as basis. Now, the basis is positive with backwardation. You can see if the futures price is lower than the spot price, then that's going to have a positive basis. If the futures price is higher than the spot price, then we have contango. Okay, so that's some basics of commodity pricing.